Every few years, a financial craze sweeps the market, turning ordinary retail investors into paper millionaires practically overnight. Right now, tens of billions of dollars are pouring into artificial intelligence. The question we have to answer is whether we are looking at the next major technological leap or simply stepping into a historic financial trap. To figure that out, we have to separate two very different concepts: value and price. An asset's value is based on what it actually does, its measurable utility. Its price, however, is just a temporary number dictated purely by what the next person is willing to pay. A market becomes dangerous the moment that disconnect happens. People stop buying an asset because they want to use it and start buying it solely because they plan to sell it to someone else later at a markup. Grasping that fatal gap between utility and price is the only way to recognize and survive the 4 strict stages of a financial bubble.
Stage 1 is discovery. A novel asset enters the market, and early investors run the numbers, making calculated, rational bets on its potential. As those early bets pay off and prices tick upward, Stage 2 kicks in: mania. Seeing others get rich triggers a fear of missing out, drawing a flood of uneducated retail buyers into the market. This triggers a psychological blind spot known as herd behavior. When people see thousands of others making the exact same financial decision, they assume that crowd must be right, completely ignoring the underlying math. This diagram maps out the upward feedback loop that takes over. New buying pushes the price up, which grabs public attention, bringing in a fresh wave of buyers with new capital, which drives the price even higher. Human psychology can inflate these numbers on its own, but it takes the introduction of external, borrowed capital to turn a hot market into a catastrophe. Banks and lending institutions act as the silent accelerants of these manias. This chart illustrates leverage. An investor puts up 10% of their own money, borrowing the remaining 90% from a bank. If the market price climbs by 10%, the investor's personal equity effectively doubles, making a massive return using someone else's money. When thousands of people do this simultaneously, cheap borrowed money floods the system. Asset prices are pushed astronomically high, completely detached from reality. Leverage makes investors feel like absolute geniuses on the way up, hiding the reality that they have completely removed their own safety net. That brings us to Stage 3, panic. The market hits a tipping point where investors suddenly realize the asset's actual utility cannot possibly justify its hyperinflated price tag. This chart demonstrates why the crash happens so fast. Because that bank debt is fixed, if the asset's price drops just 10%, the investor's personal capital is wiped out. Banks instantly execute a margin call, demanding their borrowed funds back to protect themselves. This forces Stage 4, the crash. To pay back the banks, investors are forced into immediate, desperate sell-offs. That drops the overall price even lower, which triggers another wave of margin calls, locking the market in a vicious downward spiral. The bubble doesn't pop because the underlying asset disappears. It pops because the artificial debt used to pump up the price is suddenly ripped out of the system. When the dust settles, the wealth isn't destroyed. It is simply transferred from the late, leveraged buyers directly to early investors and short sellers who saw the math. You can spot these traps before they spring by looking for 3 strict warning signs: average retail investors making fortunes with zero effort, widespread use of bank loans to buy into the trend, and a public consensus that the price can only ever go up. Not every new invention is an empty speculation. Sometimes an innovation actually delivers. A true breakthrough permanently increases human productivity and utility. A bubble just temporarily shifts who holds the money. Which brings us back to the current boom in artificial intelligence. If we look past the headlines, we have to apply our exact diagnostic framework. Massive tech companies are pouring tens of billions in capital expenditure into building infrastructure, yet the software models themselves are currently struggling to generate proportional profits or provide completely flawless utility. There's also a clear circular economic warning sign. Giant corporations are aggressively funding smaller startups, largely so those same startups can buy computing power right back from them. We are left waiting to see which way the cycle breaks. Will AI integrate itself deeply enough to become essential societal infrastructure,
Or are we witnessing another debt-fueled hype cycle? Time will tell, but history is clear. In the long run, true financial value is strictly found in what an asset produces, not what the next person is blindly willing to pay for it.